Welcome to RBC's Markets in Motion podcast, recorded July 14th, 2025. I'm Lori Calvasina, head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. The big things you need to know: first, we're lifting our year-end 2025 S&P 500 price target to 6250, essentially taking our price target back to where it was in mid-March. Second, there's no change to our 2025 S&P 500 EPS forecast of 258, which is slightly below consensus. We also review what we've learned from the early reporters, which makes us think it's too early to stop worrying about tariff impacts. And third, we're adding the momentum trade and earnings sentiment for megacap growth to the list of things worrying us about the stock market in the near term. If you'd like to hear more, here's another 5 minutes. Let's start with takeaway number 1. Updating our year-end 2025 S&P 500 price target. With the first half behind us and a fresh forecast update from our partners in RBC Economics, Rate Strategy, and FX in hand, we've done some housekeeping on the different models we use to derive our target and have made an important change to our overall framework. The punchline is that we've raised our target significantly to 6250. With this change, our price target essentially goes back to where it was in mid-March. The message we're trying to send is that we feel neutral on the market in the back half of the year and expect choppy conditions and swings in both directions. So how did we get to 6250? It's midway between the median and average of the 5 different models we're using right now. The structural change to our approach, which had the biggest impact on the overall number, is that we've just given up trying to put a quantitative value on the policy backdrop for the U.S. Previously, we were baking in the 2018 return in the stock market as a value to model for the trade war, which was a decline of more than 6%. But the stock market is no longer trading in sync with Trump's polling numbers, and investors have been telling us they've moved on from 2025 and are trading based on the outlook for 2026. So, we've replaced our policy assumption with one based on next year's GDP signal. That model points to an 8% gain on a full-year basis for the S&P 500, or a level in the mid-6,300 range. Meanwhile, 2 of our models point to roughly 5,700 on the low end. These are our usual GDP test, which looks at how stocks perform during years when GDP is in the 1 to 2% range, a decline of more than 3%. And we're also looking here at our valuation and earnings analysis, which uses house views on inflation and interest rates to derive a trailing PE target at year-end and then layers in our own EPS forecast. This right now is telling us to look for the S&P to end the year around 5,750. Meanwhile, 2 of our models are pointing to roughly 6,500 at the high end. One of those more bullish models is our earnings yield gap model, which looks at the difference between the S&P 500 earnings yield and the 10-year Treasury yield, and then the 6-month forward return in the index from those kinds of levels. The other bullish model is our sentiment model, which looks at AAII net bulls and 6-month forward return off of current levels. Both of those models point to a second-half gain in the mid to high 4% range. We know that is a lot of math to work through. The bottom line is that our messaging from the last few weeks is unchanged. The stock market is looking a bit overvalued to us on 2025 fundamentals and has some, but not a lot of room left on our more bullish models. Net bulls on the AAII survey have not hit 1 standard deviation above the long-term average yet, and we are watching that indicator closely for signs of a market top. Moving on to takeaway number 2. No change to our 2025 S&P 500 EPS forecast of 258. We've refreshed our S&P 500 EPS model for the latest house views on GDP, inflation, and rates. Generally, our teams see GDP in the mid-1% range, inflation just under 3% at the end of the year, 10-year yields a bit over 4%, and Fed cuts they now have starting in December as opposed to their earlier call of September. The punchline is that we're sticking with our 258 forecast for 2025, which is a bit below the bottom-up consensus of 265. Macro-wise, the interest rate backdrop is less favorable than our last update for the back half of 2025. However, we've also baked in a slightly more favorable margin backdrop for stocks in the second half of the year, removing our prior assumption for some very modest contraction. Those 2 changes essentially offset each other. On the upcoming reporting season, a couple of quick thoughts. First, the rate of upward EPS estimate revisions in the S&P 500 has moved into the mid-50% range, a typical non-crisis high, making us worry the recent healing in earnings sentiment could be about as good as it gets for a while. Second, we spent some time last week reading through the earnings calls of companies across the market cap spectrum that have reported since the last week in June. Though there have been a couple of company bright spots that have gotten a lot of attention, it hasn't been all sunshine and roses. Uncertainty over tariffs, hesitancy, pricing, and inflation were all in focus, and we were struck by some descriptions of the disruption to demand in the quarter. We'll be paying close attention to what companies are saying about pricing, inventories, and demand, both the pull forward and the freeze from uncertainty, and cost management in coming weeks. One idea lurking in the back of our minds is that adverse impacts from tariffs may end up getting pushed into 2026, and we'll be looking for information that either supports or counters that notion. We'll wrap up quickly with takeaway number 3, new worries. The first of these is that the momentum trade appears to be fading. Since 2024, when this happens, it tends to come ahead of a drawdown in the S&P 500 with a lead time of a few days to a month. We saw this ahead of April's tariff tantrum, as well as the other 4 to 8% drawdowns that have occurred since 2024. The second is that megacap growth performance and earnings revision leadership do often fade in reporting season. And a third worry is that in just 3 months since the April 8th low, the snapback in the S&P 500 has done what it typically sees in a 9-month recovery period off of a major non-recession low. Other worries we've talked about before include poor equity market seasonality in August and into the fall, and the possible dialing down of Fed cuts, which has been an important part of the bull thesis in U.S. equities of late. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.